A simple mistake on your taxes could trigger an IRS audit. Here's how to stay out of trouble. In this video, I want to talk to you about what you need to know about tax audits, what they are, why they happen, and how to avoid them. Let's get started. Hey taxpayers, it's Tiffany Gonzalez CPA. First, let's define a tax audit. Simply put, a tax audit is when the IRS takes a closer look at your financial records to ensure you're paying the right amount of taxes. This includes reviewing your personal details, business information, and financial statements. The goal of the IRS is to confirm that your income is reported accurately and your deductions are legitimate. Now, let's talk about what could trigger an audit. While some audits happen randomly, others are sparked by specific red flag. Income discrepancies, like underreporting your income from side jobs or investments or earning a significantly higher than average income, can catch the IRS's attention. Unusual deductions, such as excessive charitable donations, disproportionately large business expenses, or improperly claimed home office deductions, are also common triggers. Simple math errors or incorrectly claiming credits like the earned income tax credit or the child tax credit can raise suspicion as well. Businesses that primarily deal in cash, foreign bank accounts that go unreported, or a history of past audits can also further increases your chance of being audited. The IRS compares the information on your tax return with data from employers, banks, financial institutions. Any discrepancies can result in a review. And here's a lesser known fact. Your audit can be triggered by an association. If someone you work with or share finances with is audited, you might land on the IRS's radar too. Now, not all audits are created equal. There's three main types of audits. The first is correspondence audits. These are handled through the mail. The IRS may request additional documents to clarify something specific on your tax return. The second type of audit is an office audit. This involves an in-person meeting at an IRS office to discuss specific items on your return. Line-by-line audits. These are the most detailed, with the IRS reviewing every line of your tax return. Let's be real, no one wants to deal with an audit. And while they're not 100% avoidable, you can reduce your chances by accurately reporting all income. By double-checking your tax return for errors before filing and signing. By following IRS rules for deductions and credits. And you can do all of that by working with a trusted and very good CPA. If you do get audited, respond quickly, stay calm, provide clear, organized records, and that is the best way to resolve it. Now, you might be wondering, how long do I need to keep looking over my shoulder for an audit? The IRS typically has up to 3 years after you file a return to audit it. But if there is a significant underreporting, that window can stretch to 7 years. If you fail to file a return or report foreign accounts, there's no time limit. And that's why it's so important to keep up with your filings and file to begin with. Here's a common question. What if I lose an audit? The good news is losing doesn't necessarily mean jail time. Usually it means you'll need to pay the corrected amount of taxes owed plus any penalties and interest. But of course, no one wants to pay penalties. That's why staying organized with your records isn't just smart, it's essential. And there you have it. That's a complete breakdown of most tax audits. Remember that audits don't have to be scary. If you stay informed, if you stay organized, if you stay proactive, and if you're a client of ours and you've received a notice from the IRS, don't hesitate to reach out to us. We are here to help. We really hope you enjoyed this video. Don't forget to hit the like button, subscribe to our YouTube channel. Until the next video, your favorite CPA, Tiffany Gonzalez.